In today's session, we would be discussing another numerical of the preparation of final accounts. And as a part of today's discussion, we would be picking up on a question which is slightly complex, and then I would be laying special emphasis to one specific adjustment in today's session, which is income received in advance. In the earlier sessions, we had already discussed upon this, but nonetheless, let me just bring that up once again. Now, here in this particular numerical that we're solving today, we would be touching upon income received in advance. Now, what is income received in advance? Income received in advance is the revenue that your business is earning even before the product has been delivered or the service has been rendered to the client. So even before that has been done, you end up making the payment. So it's something like this. Let's say you want to buy a car, but the car that you want to buy, it will be available in the market only next year. Okay, so you're making the payment upfront. So for the business who's receiving the payment from you, it is income received in advance. Or let's say, in this usually happens. This is a usual arrangement which happens in the real estate industry. There's something which is called as pre-booking, which happens for flats. So even before the groundbreaking for a real estate project has taken place, interested parties or interested customers are given the option to buy or purchase the flat. Now, for the real estate company, this is income received in advance. Why? Because the building has not even been constructed so far. So it is income received in advance is nothing but an income that is earned even before the product has been delivered or the service has been rendered to the customer or to the client. Now, what is there any drawback or is there any challenge that the accounts department faces with respect to this transaction? Yes, there are quite a few problems, there are quite a few challenges that the business faces with respect to income received in advance. You see, for every sale transaction that the business carries out, it is mandatory for them to generate a receipt or a bill. Okay? It is mandatory for them to generate a receipt or it is mandatory for them to generate a bill. But if even before the product has been delivered or even before the service has been provided, how do you generate the bill? Can you generate the bill? You cannot generate the bill. Why? Because the product has not been given or the service has not been rendered. Okay, so which means for whatever money that the business is collecting, it is practically challenging for them to create a corresponding document to account for that money. So this is one major drawback that is faced by the business. Why? Because this money cannot be accounted for. Why is it that they cannot account for this money? The reason why they're not able to account for this money is because a corresponding invoice or a bill cannot be generated. Then what does the business do with this money? What the business will be doing is they will be carrying this forward until such time that the actual delivery takes place. Okay, this will be carried forward until such time the actual good or the service gets rendered or given to the customer. Okay, so now, how do you go about with respect to income received in advance? In your profit and loss account, it is treated as an indirect expense, and then in your balance sheet, it will be shown as a current liability. Okay, so what happens here we hear it is shown as an indirect expense. Please remember, I'm repeating this once again, though this is income received advance, you're showing this as an expense. Why are you showing this as an expense? Because you're not able to generate a corresponding bill for it. You're not able to generate a corresponding receipt for it. So until such time, you were forced to show this as your indirect expense in your profit and loss account, and in your balance sheet, it will be shown as a current liability. So this is the treatment with respect to income received in advance. So with that note, let us continue with our discussion on the numerical that we will have planned for this session. And let me bring up the question here for you. The following balances are extracted from the trial balance of ABC, excuse me, ABC Limited. you are required to prepare trading, profit and loss account and balance sheet for 31st March 2005. And then they've given you the trial balance, and the trial balance is quite big, and they've also given you some adjustments. So this is the question that we have to prepare for. Now, let's start preparing the final accounts for this particular question. So in this particular question, we are discussing about the apprenticeship premium, and we know that the apprenticeship premium, which is paid for 3 years, is rupees 3,000. Now, in the adjustment, we've been told that the premium that you're paying in advance. Okay? You're paying in advance for 3 years, and you're paying as on 1st Jan 2005. Now, remember the rupees 3,000 that you're paying, it is spread across 3 years. So it would be 2005, 2006, 2007. So I'll repeat that. It is 2005, 2006, and then 2007. So the amount is spread across 3 years. And the years for which it is corresponding is 2005, 1,000, 2006, 1,000, 2007, 1,000. Okay, so this is how the amount is spread across 3 years. Now, in this, out of the 3,000 rupees that you pay, 1,000 rupees is for the current year. Out of the 3,000 rupees of the total apprenticeship premium that you paid, 1,000 rupees is for the current year. The remaining 2,000 rupees, which is for 2006 and 2007, this is nothing but income received in advance fee. Okay, this is nothing but income received in advance. So this is how we would be going with regards to the treatment of this particular adjustment regarding the apprenticeship premium. So the very first statement that we will be preparing as a part of the final accounts is your trading account. We prepare the format of the trading account, and let us quickly prepare the trading account. We start off with opening balance. Okay, we start off with the opening balance. Opening balance is 16,000. Okay, the opening balance is 16,000. The next item that we have is purchases. Okay, the next item that we have is purchases, and purchases is 40,000. Then we have purchase return. Purchase return is 800. So purchase return is 800. To get the net purchase, it will be purchase minus purchase return. It will be purchase minus purchase return. Then you have, now we are moving on to the direct expenses. What are the direct expenses that we have? The direct expenses that we have are your wages. Wages is 6,600. Okay, wages is 6,600. We also have a corresponding adjustment to this, which is wages outstanding. Okay, which is wages outstanding, and wages outstanding is 600. So from wages, if you subtract wages outstanding, the net amount works out to be 6,000. Okay, the net amount works out to be 6,000. So we've considered that. Now, which are the other direct expenses that we have? The other direct expenses that we have are free charges. Now, what is meant by free charges? Free charges refers to the transportation cost of the raw material. It refers to the transportation cost of the raw material. That also we have considered, and the amount works out to be 4,800. Okay, the amount for free charges, that works out to be 4,800. So that also we have considered. Now let us see if there are any more direct expenses that we have. Let's just quickly look through the given trial balance, and let's see if there are any more direct expenses. We do not have any more direct expenses, so we have pretty much covered most of the direct expenses. Okay, now we can move on to the credit side. Now let's quickly move on to the credit side. Credit side, we have sales. And how much is sales? Sales is 1,60,000. Now from corresponding to sales, we have sales return as well. How much is sales return? Sales return is 3,000. So from sales, total sales, if you subtract sales return, you would get the net sales. Net sales is 1,57,000. Then we have closing stock. How much is closing stock? Closing stock is 14,000. Closing stock also we have considered. Okay, we have closing stock. Okay, I just happened to notice I made a small error with respect to the wages outstanding. I had subtracted. It is not subtraction, it is the addition. Since it is outstanding, it was my mistake. Since the wages are outstanding, it should not be subtracted, it has to be added. Okay, it has to be added. So that also we have to just make a note of that correction. Also, there's one item that I had missed out, which was carriage inward. Please remember, carriage inward is a direct expense. Okay, carriage inward is a direct expense. Carriage inward also we have considered, and that is 2,400. Okay, so that is 2,400. So I just want to quickly cross check if we have any more. If we have any more direct expenses. We do not have any more direct expenses. So which means we can go for balancing of the trading account. Now, when we balance the trading account, we notice that the debit side is more. Okay, we notice that the credit side is more. Credit side is more than the debit side, which means here the balancing figure will be falling on the debit side. If the balancing figure were to fall on the debit side, it would be referred to as gross profit. If the balancing figure were to fall onto the debit side, it would be called as the gross profit. So now let me just quickly take the difference of the amount and calculate that. Gross profit works out to be 1,01,400. I repeat, the gross profit works out to be 1,01,400. So that is the gross profit. So gross profit, we have estimated the gross profit. Now let us move on. The next statement that we have to prepare as a part of your final accounts is the profit and loss account. Now, profit and loss account, we have to bring down the gross profit, and gross profit has been brought down to the credit side. Now, let's try and consider all your direct expenses. Okay, let's consider all the direct expenses that we have. The first direct expense that we are considering is the carriage outward. Carriage outward, the amount is 5,000. If the amount is 5,000, 5,000 has been considered. Next, what we have is salary. Okay. Salary and the amount is 11,000. The amount is 11,000, and salary outstanding is 1,000. We also have an outstanding salary, and outstanding salary that we have to add. Outstanding salary has to be added, and that is 1,000. Okay, that is 1,000. So 11,000 plus 1,000, the total amount works out to be 12,000. So your total salary component works out to be 12,000. Now, which are the other direct expenses that we have? The other direct expenses that we have is rent. Okay, so let's proceed. Rent is 2,200. Okay, rent is 2,200. Rent outstanding is 2,200. So it has to be added, and together it has to be 2,400. Okay, it has to be 2,400. Then the next item that we have is insurance premium, and insurance premium. Insurance premium, the amount is 1,800, and we also have to check and see if we have an adjustment corresponding to this. We also have to check and see if we have an adjustment corresponding to this. So to insurance, we do not have any. We have insurance prepaid. If we have insurance prepaid, since it is prepaid, we will have to subtract. The insurance has to be subtracted, and the amount that we have to subtract is 600. So 1,800 minus 600, that leaves us with 1,200. Okay, now moving forward, we have considered insurance. Next item that we have is bad debts, and bad debts also we have considered. Bad debts is a direct expense. Sorry, it's an indirect expense which goes into your profit and loss account. That has also been considered. Okay. Then you have discount, and then discount is here it is discount allowed, so it will fall on your then you have stationery. Stationery, the amount is for stationery the amount is 500, so that amount also we have considered, and we also have an adjustment corresponding to stationery, and we say and the adjustment is that we have an outstanding stationery bill. So since we have outstanding, what we will have to do is we will have to add. And the next item is taxes. Taxes is a direct expense that we have considered. Then we have traveling expense. Traveling expense is also an indirect expense that we have considered. Then we have trade expenses. Trade expenses will fall on the debit side. That also we have considered, and that is also been taken into consideration. So that is also completed. Okay, moving forward, we have we pretty much covered we have covered most of the items. Now we have to consider the adjustments. Okay, so adjustments, let's look at the adjustments one by one. We have salary outstanding, that is that we have already taken. Rent outstanding, that also we've considered. Insurance prepaid, that also we have considered. Then you have apprenticeship premium. Now apprenticeship premium, we have to go with the item. At first, you have apprenticeship premium, which is given to us in the trial balance on the credit side. So we are treating that as an income. We are treating that as an income that has been considered. Then you have 2 years apprenticeship premium, which is received in advance. So what we have to do is we are treating that as an expense, and what I'm going to do is I'm going to subtract it over here. Okay. Why? Now, because this apprenticeship premium that you have received in advance, technically it is an expense, which means it has to fall on the debit side. But I already have a corresponding item, which is apprenticeship premium, and which is an income which is falling on the credit side. So I wish to subtract from the main item itself. So the net amount would be 1,000. Okay, so the net amount would be 1,000. Then you have outstanding stationery bill, that has also been considered. Now we have to consider the depreciation. Depreciation. So let me consider the depreciation now. So I just need to build some more space. Okay, now depreciation, the first depreciation that we have to consider is on land and building. So on land and building, depreciation is charged at 5%. So 5% of the value of land and building, that will be 5% of 1,10,000. Okay, 5% of 1,10,000. So let us consider that, and that works out to be 5,500. That amount works out to be 5,500. Then we have to charge depreciation on furniture. On furniture, the depreciation is charged at the depreciation is charged at 10%. So 10% of what amount? 10% of 5,000, which is 500. Then we have 10% of machinery. So 10% of machinery, which works out to be 10% of 10% of 9,000, which is 900, which is 900. Okay, which is 10% of 9,000, which is 900. Then you have interest on loan accrued. So interest on loan accrued is what? It is nothing but a income. Okay, it is nothing but an income. And interest on loan accrued is at the rate of 7%. Now 7% of what? 7% of 10,000. So 7% of 10,000 is 700. Then you have interest on investment. Interest on investment is at the rate of 2.5%. Now 2.5% of what? 2.5% of 6,000. Okay, so 2.5% on 6,000 is 2.5% on 6,000 that we will have to calculate. Which is 150. Then we have one more item, which is interest on capital. Interest on capital is an expense, and that we have to consider on the debit side. So sorry, it is interest on capital. So interest on capital we will have to calculate. Interest on capital will be calculated at 5%, and then 5% of capital, which is 1 lakh. 5% of 1 lakh is 5,000. Okay? 5% of 1 lakh, which is 5,000. So that has been calculated. Okay? So that has been calculated, and let's try and balance the debit side and the credit side. So here, if you notice, the credit side is more and the debit side is less, which means the balancing figure will be falling on the debit side. If the balancing figure were to fall on the debit side, it is referred to as the net profit. Okay, it would be referred to as the net profit. So net profit we have got, and net profit we will have to calculate. We have to find out the balancing figure, and the balancing figure would be the difference between the amounts that we have mentioned over here, and that works out to be 63,590, which is your balancing figure. Okay, so that is your balancing figure. Now let's move on to the next statement. The next statement that we have to prepare is your balance sheet. Balance sheet, we have the opening capital. Opening capital is 1 lakh. We do not have any additional capital. We have interest on capital. Interest on capital is 5,000. In this question, since we have net profit, we will have to we have net profit. That amount has to be considered. So that is 63,590. Okay, 63,590. Then we have drawings, and the drawings amount is 6,000. Okay, drawings amount is 6,000. Interest on drawings is 0. So with that, we have completed the capital section. Okay, we have completed the capital section. Now let's quickly look at the remaining items. The remaining items that we have over here is land and building. Land and building is a okay, that is a land and building, that is a fixed asset, and we also have a corresponding adjustment to that, which is depreciation. So from that we have to subtract that. So 1 lakh minus depreciation, 1,10,000 minus depreciation, we've got that amount, and then so we have 5,500 as the depreciation amount. So 1,10,000 minus minus 5,500, your net net land and building amount is 1,04,500. Now we have to consider the remaining items as well. We have furniture as well. We have depreciation. So we depreciation on furniture is 500, and the furniture value is 5,000. So 5,000 minus 500, the amount works out to be 4,500. Then we have bills receivable. Bills receivable is a current asset, so let's put that on under current assets. Then that amount is 7,000. Okay, so that has been calculated. Now, the next item that we have to consider is debtors. Debtors is again a current asset. So debtors also we have taken, and the debtors amount is 40,000. The next is machinery. Machinery is again a fixed asset. So let's put that into the machinery part. And then for machinery also we have an adjustment, and the adjustment is depreciation. And depreciation for machinery is that also we have to factor, which is 900. So the effective amount works out to be 8,100. So the effective amount works out to be 8,100 that we have considered. Now we have to consider the investments. Now the investments that we have over here are loan given. Now why is loan we are considering as an investment? Because here in this case we are lending out the loan to someone. That's the reason why we are considering that as an investment. So the loan in this case, the loan amount, we are showing it as an investment because here it is loan given, and loan given is an asset. So how much is loan? Loan given is 10,000. Then we have a corresponding adjustment to this, and the adjustment is that is that interest accrued. So that we have to add. So accrued interest is 700, and the total amount is 10,700. Then we have investment. So investment, how much is investment? Investment is 6,000. Okay? Investment is 6,000, and interest on investment accrued. The interest on investment that is accrued is 150. Okay? So interest on investment accrued is 150. That also we will have to consider. So this is 6,150. Okay, so okay, now moving on, we have cash in hand. Cash in hand is a current asset, so that we have considered. This is cash in hand is 500. Then we have cash at bank. Cash at bank is 7,000. Okay, there was a small correction over here. Thank you for pointing that out. Here, the accrued interest we have to add. It was a typo error from my end. However, the total amount is correct. I have added. Okay, so then we have creditors. Creditors will be going on the current liability side. Creditors we have considered, and creditors amount is 31,600. So that we have written. Then we have bills payable. Bills payable, the amount is 5,000, and that 5,000 we have shown over here on the liability side. Now there are some more adjustments that we have to consider. The adjustments, there are some more adjustments that we have to show over here. So let me just quickly do that as well, because our balance sheet is yet to tally. Then we have apprenticeship premium. Now apprenticeship premium, here we have apprenticeship premium, which we have received in advance. Okay, we have apprenticeship premium that we have received in advance, and that the amount is 2000. Okay, which is 2000. Okay, now we have closing stock. Closing stock is an asset. It is a current asset that we have shown. Then we have wages outstanding. Wages outstanding is a liability that the amount is 400. Then you have salary outstanding, which is again a current liability, and the amount is 1000. Then we have rent outstanding. Rent outstanding is also that is also a liability for us, and rent outstanding, the amount is 200. Then you have insurance prepaid. Insurance prepaid is a current asset, so that you have to treat it on the asset side. That also we have considered. So insurance prepaid, the amount is 600, so that we have considered on the asset side. Apprenticeship premium we have considered, that is we have already considered as an adjustment. We have stationery outstanding bill, and the amount is 60, so that also we have considered. Then we have considered depreciation. We have considered interest on loan. Okay, so thank you for pointing that out. My wages outstanding, the amount was incorrect. It is 600. So with that note, if you notice, my balance sheet has actually tallied, and my balance sheet is now, my asset is tallying with my liability side. So with that, we've completed the preparation of the final accounts for this particular question.